On May 4, 2026, U.S. rate markets reflected a policy error setup, with tight near-term pricing, but growing expectations for later easing if growth weakens. That was the day's cleaner market signal, not a guaranteed recession call, but a warning that equities were balancing inflation pressure against growth risk. The shape traders were watching looked like a frown. Near-term rates stayed pressured because oil and inflation risk were still alive, while later rate pricing leaned toward cuts if the economy loses momentum. That combination matters because it says the market is not simply cheering growth, it is pricing a narrower path. The stock tape matched that caution. The S&P 500 fell 0.4% to 7,200.75 after its latest record high. The Dow lost 1.1%, and the Nasdaq slipped 0.2%. The message was not panic, it was hesitation at expensive levels. Oil was the stress point underneath the move. Brent crude jumped 5.8% to $114.44 as fighting around the Strait of Hormuz kept traders focused on supply risk. 2 U.S.-flagged merchant ships reportedly made it through the strait, but the market still treated the route as uncertain. That is why rates, oil, and equities belonged in the same story. Higher energy costs can keep central banks sounding hawkish, even when the bond market starts looking past that pressure toward weaker growth. For stocks, the risk is a policy squeeze at the wrong point in the cycle. AI spending stayed in the background, but it was not the market's main driver today. The big tech buildout is still a massive bill, with major cloud and platform companies planning hundreds of billions of dollars in capital spending this year. The question is whether that spending keeps producing revenue before investors lose patience. The tougher version of the AI question is labor. If companies spend heavily on infrastructure while hiring cools in parts of the private economy, the market has to decide whether AI is lifting productivity or masking weaker demand. That is a valuation problem, not just a technology story. Memory supply added a concrete bottleneck. Micron's March update said DRAM and NAND demand in 2026 is constrained by supply, and that tight conditions are expected to last beyond this year. New capacity helps, but some meaningful shipments are still tied to 2027 and 2028 timelines. Palantir gave the other side of the argument. The company reported first-quarter revenue of $1.633 billion, up 85% year-over-year, with U.S. revenue up 104%. It also lifted full-year guidance to 71% growth. That is why AI software momentum still matters, even in a cautious tape. Tesla showed the capital intensity problem in a different form. Its April earnings call reset 2026 capital spending expectations above $25 billion. The company has cash, but the spending plan raises the bar for robotaxi, Optimus, AI chips, and factory returns to show up fast enough. Stablecoins were a policy-side catalyst, but the key point is implementation. The Genius Act already became law in 2025. The live 2026 development is that regulators are writing the framework for payment stablecoin issuers. For Circle and crypto-linked equities, the catalyst is regulatory clarity moving from statute to operating rules. Market breadth stayed narrow near record highs. That keeps pressure on the same crowded areas: AI infrastructure, semiconductors, and a short list of high-growth software names. A narrow rally can keep working, but it gives the market less room for disappointment when rates, oil, or earnings surprise. From here, watch 4 things: rate cut pricing versus inflation pressure, Brent crude and Hormuz traffic, whether AI Capex keeps turning into actual revenue, and whether earnings from names like Palantir can broaden the rally. The market can still climb, but the margin for error is thinner now.